Welcome to QIS Financial Accountability. Today we're going to have a brief look at the second topic, which is keeping track of money. There are a number of reasons why we need to keep track of money. One is to make sure it is safe and that we can account for all the income and expenditure of the organisation. Another reason is for reporting, budgeting and monitoring, so that we can see where money has been spent in order to see whether we are meeting budget objectives. We can plan for where there are gaps and assess where savings can be made. There are 3 standards that we're going to cover today. The first one is a valid supporting document is obtained for every transaction, securely filed and stored for the minimum period required. A supporting document shows that the transaction actually took place and can help prevent misuse of funds, such as ghost transactions where entries are made that don't actually exist, or duplicate entries where something is entered twice in different parts of the accounts. Supporting documents could be receipts, invoices that are stamped paid, bank statements, paying in or deposit slips. Money received as income should be receipted by the organisation. It is best to use duplicate receipt books if possible, so that a receipt can be given to the person giving the money, but a copy can be kept for your own records. You should require receipts for all expenditure, or where this is not possible, you could use other forms of documentation, such as an acknowledgement form which has your organisation header or logo, and the person receiving signs and dates acknowledgement of the money. For example, this might be useful for local community members receiving a transport allowance for attending an activity. The second standard is there is a cash book where money, cash, cheques and wire transfers and other resources received and disbursed are recorded, with a record of the date, description and amount of every transaction. The cash book is reconciled every month. A cash book could be either manual or computer-based. At a minimum, this would be a bank book for each bank account and a petty cash book, but for larger organisations, it will probably be part of a full bookkeeping system. Unless you are a very new or very small organisation, you will likely already have your system in place. But it can be useful at this point to confirm that all of your records are kept in detail, and most importantly, that they are reconciled at least monthly. For more risky accounts such as petty cash, or where there are a lot of transactions, you could consider reconciling weekly. The third standard is a chart of accounts is produced, which is used consistently in the accounting records and budgets. A chart of accounts is a tool that can be used for recording all transactions so that you can report correctly and categorize certain types of transaction, for example, administration, personnel, or vehicle costs. The chart of accounts is a list of account codes under the headings of income, expenditure, assets, and liabilities. These codes are then used consistently through reporting and budgeting, and your chart of accounts should include descriptions of what each account is used for and a logical numbering system. This should be made available in some format to staff who need to either requisition for money or if they are part of the planning and budgeting process, so that codes are used correctly and consistently. We hope you can join us for the webinar on Tuesday, where we will unpack in a little more detail, and you will have the opportunity to comment or ask questions.